Before there were borders drawn with ink, before flags were stitched and thrones were raised on stone, there was chaos disguised as freedom. Humanity traded not with numbers, but with trust, fear, hunger, and survival. A fisherman exchanged his catch for grain. A farmer bartered his harvest for protection. A blacksmith forged weapons in return for livestock. Every exchange depended on memory and reputation. Nothing was written. Nothing was guaranteed. And when memory failed or trust broke, violence decided the value of things. In that world, there was no referee, no neutral judge to say who owed what, who had paid enough, or who had cheated the game. Power belonged to the strong, and fairness belonged to whoever could enforce it. As societies grew, this chaos became unbearable. Villages turned into cities, cities into empires, and suddenly a simple barter was no longer enough. A farmer could not trade grain directly with a potter he had never met. A soldier returning from war could not carry cows or sacks of wheat across continents. The larger humanity became, the more it needed something invisible yet trusted, something lighter than goods but heavier than promises. That need gave birth to money, not as an invention of greed, but as a desperate solution to disorder. The first coins were not created to make people rich. They were created to make people agree. Stamped pieces of metal appeared in ancient Lydia, Greece, China, and India, carrying the mark of a ruler or a state. That stamp was not decoration. It was authority pressed into metal. It said, "This has value because power stands behind it." In that moment, money became more than an object. It became a judge, deciding how much work a life was worth, how many days of labor equaled survival, and who could command the efforts of others without lifting a sword. But money was still young, and its power was limited. Kings ruled directly. Armies enforced decisions. If debts were unpaid, prisons or executions followed. Finance served power, not the other way around. That balance would not last. Empires discovered something terrifying and brilliant. Wars were not won only by soldiers. They were won by supply lines, by wages paid on time, by food arriving before hunger broke morale. An army that could not be paid would mutiny. A navy that could not be supplied would rot at sea. Slowly, rulers realized that controlling money was not just administration. It was command, and those who could fund wars without fighting them became more powerful than generals. In ancient Rome, this truth emerged painfully. Rome conquered lands with iron, but it ruled them with coins. Taxes extracted wealth from provinces and flowed back into the capital, feeding legions and spectacles. But Rome also learned the dark side of finance. As emperors debased silver coins, reducing their purity to stretch resources, inflation crept into markets. Prices rose. Trust weakened. The currency still looked the same, but its soul had changed. For the first time, money itself began to lie, and society felt the consequences. Rome did not collapse only from invasions. It collapsed from financial decay, from a system that could no longer honestly measure value. After Rome fell, Europe fractured into feudal chaos. Coinage existed, but authority was scattered. Lords minted their own money. Trust was local, fragile, and temporary. Trade shrank. Knowledge stagnated. Once again, the world lacked a single financial referee. But history never moves backward forever. Commerce returned, carried by merchants, caravans, and ships that crossed seas and deserts. With trade came credit. With credit came debt. And with debt came the quiet rise of those who controlled it. Medieval bankers did not wear crowns, but kings kneeled before them. Families like the Medici financed wars, crowned rulers, and toppled rivals without marching armies. They introduced letters of credit, early banking instruments that allowed wealth to travel faster than gold. For the first time, money moved independently of physical power. A signature could now command more than a sword. The financial umpire was taking shape, invisible but decisive. Still, there was no global referee. Every kingdom played by its own rules. Exchange rates were chaotic. Trust was personal. That changed as empires expanded overseas. The age of exploration was not driven by curiosity alone. It was driven by profit, debt, and competition. Ships required massive investment. Voyages could fail. Only those who could absorb losses survived. This gave rise to joint stock companies, early corporations where risk was shared and profits were multiplied. Money was no longer personal. It became systemic. The Dutch understood this before anyone else. In the 17th century, the Netherlands created the first modern financial system. Amsterdam became the heart of global trade, not because it had the strongest army, but because it had the strongest trust. The Bank of Amsterdam stabilized currency values, standardized transactions, and acted as a neutral anchor in a chaotic world. For the first time, money behaved like a referee, enforcing consistency, punishing dishonesty, and rewarding discipline. Nations trusted Dutch finance because it worked. And in trusting it, they surrendered a piece of their sovereignty. Then came England, watching carefully, learning patiently. England realized that wars could be won not by draining the treasury, but by borrowing against the future. In 1694, the Bank of England was created, not as a public service, but as a private institution lending money to the state. This was a revolutionary idea. The government no longer needed gold up front. It needed credibility. Debt became institutionalized. Bonds replaced plunder. And the financial umpire stepped onto the field permanently. From that moment, power shifted. Kings who could borrow cheaply ruled longer. Nations with stable credit crushed those without it. The umpire no longer shouted orders. It whispered interest rates. A country that displeased the markets paid more to survive. A country that obeyed was rewarded with growth. Finance was no longer a tool. It was a system of discipline. Gold emerged as the ultimate neutral judge. Unlike kings, gold did not lie. Unlike paper, it could not be printed. Nations tied their currencies to it to prove honesty. The gold standard was born, creating a shared language of value across borders. Trade exploded. Trust expanded. But the system was rigid. When crises came, gold could not bend. Economies bled because the umpire refused to compromise. By the 19th century, the world was playing a dangerous game. Industrialization accelerated everything. Wealth multiplied, but so did inequality. Banks grew larger than governments. Crashes rippled across continents. And every time chaos threatened to return, finance stepped in, not to save people, but to save the system. The umpire did not care who suffered, only that the rules held. By the time the 20th century dawned, the first financial umpire was no longer a concept. It was a force. Invisible, unemotional, relentless. It decided which nations industrialized, which collapsed, which fought wars, and which starved quietly under debt. Money had learned to judge humanity, and humanity had agreed to be judged. But this was only the beginning. By the time humanity realized money was no longer a servant but a judge, it was already too late to reverse course. The referee had stepped onto the field quietly, wearing no uniform, carrying no weapon, yet commanding absolute obedience. Governments still spoke the language of power, flags still waved, and speeches still promised freedom, but beneath all of it lay a deeper authority. The financial umpire no longer waited for wars to end or kings to fall. It decided outcomes before battles began, before laws were written, before citizens understood the cost of survival. The great illusion of modern history is that nations fight wars with courage and ideology. In truth, wars are fought with credit. When cannons roared across Europe and oceans filled with warships, it was not bravery that sustained them. It was loans. Governments issued bonds, promising future labor to pay for present destruction. Banks financed slaughter, not out of hatred, but out of certainty. War was profitable if managed correctly, and the umpire ensured the rules favored those who could borrow endlessly. Paper money changed everything. Once currency was freed from metal, value became abstract. A note was no longer worth what it was made of, but what people believed it represented. This belief could be expanded, manipulated, or destroyed. Governments printed to survive crises, to pay soldiers, to calm unrest. Each time they did, they fed the umpire more power. Because once money became trust-based, whoever controlled trust controlled society itself. Central banks emerged as guardians of stability, but stability for whom became the unspoken question. They claimed neutrality, yet their decisions shaped millions of lives. Raise interest rates and businesses suffocated. Lower them and bubbles formed. Inflate the currency and savings died quietly. Deflate it and unemployment rose like a silent epidemic. No army could cause such widespread effects without resistance, yet financial decisions passed as technical necessities. The umpire did not explain itself. It did not need to. The Great Depression revealed the true face of financial judgment. Markets collapsed not because people forgot how to work, but because confidence evaporated. Factories stood idle beside hungry crowds. Food existed, labor existed, but money refused to flow. The umpire had blown the whistle, freezing the game. Governments panicked, blaming greed, speculation, fate. But the deeper truth was simpler and more terrifying. When money stops moving, society stops breathing. In response, governments tried to reclaim control. Regulations were written. Gold was abandoned. Paper money became law by decree. This was not freedom from the umpire. It was surrender disguised as reform. By removing gold, nations gave the referee flexibility. Now it could bend rules instead of enforcing them rigidly. Crises could be delayed, debts rolled forward, consequences postponed. The game could continue indefinitely, as long as belief remained intact. World War II did not end with victory parades alone. It ended with a financial agreement. At Bretton Woods, the modern umpire was formalized. Institutions were created to oversee global stability, manage currencies, and intervene when nations failed to follow acceptable behavior. The International Monetary Fund and World Bank were not conquerors. They were supervisors. They did not rule countries directly. They disciplined them through conditions, loans, and restructuring. Obedience was rewarded with aid. Resistance was punished with isolation. For developing nations, this system became a maze with no exit. Loans meant growth, but growth required obedience. Obedience required austerity. Austerity weakened populations, sparked unrest, and justified further intervention. Debt became permanent, not as a failure, but as a feature. The umpire no longer aimed to resolve games. It aimed to keep them running. In wealthy nations, the system appeared kinder, but it was no less controlling. Citizens were taught to measure life through numbers. Credit scores replaced character. Mortgages defined adulthood. Retirement depended on markets behaving rationally. Every person became a player, whether they understood the rules or not. The umpire judged constantly, invisibly, without appeal. Technology accelerated this dominance. Money moved faster than thought. Algorithms traded billions in seconds. Decisions once made by committees were handed to machines, optimizing profit without morality. The referee no longer even watched the game. It analyzed data streams. Crashes happened not from panic, but from automated reactions cascading beyond human control. When systems failed, governments rushed to save them, not because they loved banks, but because the entire game depended on them. This revealed the final truth. The financial umpire was no longer external to society. It was society. It dictated education choices, career paths, healthcare access, and even personal relationships. Love bowed to economics. Dreams adjusted to debt. Freedom became conditional upon financial compliance. And yet, humanity continues to believe it is free. Because the umpire does not shout commands. It offers incentives. It rewards obedience with comfort and punishes defiance with uncertainty. It convinces people that success is personal and failure is individual, hiding the structure behind the outcome. The most powerful judge in history never declares verdicts aloud. It lets people blame themselves. Today, the umpire faces a paradox. Debt has grown beyond repayment. Currencies exist only because everyone agrees not to question them. Trust is stretched thin by inequality, instability, and invisible manipulation. The referee keeps the game going, not because it is fair, but because stopping would reveal that the scoreboard no longer reflects reality. The future of the financial umpire is uncertain, but its nature is not. It will not disappear. It will evolve. Digital currencies, surveillance finance, programmable money, and algorithmic governance are not revolutions. They are upgrades. The referee is becoming faster, smarter, and more intimate. It will not just judge economies. It will judge behavior. And perhaps the greatest irony of all is this. Humanity created money to bring fairness to exchange, to replace violence with agreement, to make cooperation possible at scale. In doing so, it created the most powerful authority it has ever known. An authority without a face, without a voice, without a conscience. The first financial umpire was never a single institution or empire. It was the moment humans agreed that numbers could decide their worth. The game is still playing. The umpire is still watching. And humanity is still pretending it understands the rules.